Welcome, everyone. Welcome, welcome. And while you're waiting, go ahead and pull up your latest profit and loss statement and your latest balance sheet if you have it available. If not, just take notes. Okay. So you're not going to be sharing it with me. You're not going to be reporting. This is not school, but I do like workshops. I don't like meetings, right? So, or presentations, as they say. So I want this to be interactive, and we're going to be teaching you how to calculate your own numbers. If I say anything that sounds like jargon
Mm-hmm.
or, like, what does that word mean? Stop me. I really try hard not to use jargon or acronyms or anything like that. But it's just something that I eat and breathe every day that I can't help it.
Mm-hmm. Sure.
So I really want this, though, to be something you can take back and use in your business. And every month, I want you to be looking at these numbers. And now you know the so what. So at the end of our time together, you're going to know so what. Well, welcome, everyone. And thank you, Jean Marie, for letting me join you all today and present my knowledge, my little piece here for you guys. My name is Christina Gamache, kind of like chocolate ganache, but with an M. And I own a little company called AudAx Wealth Management. And a little background on myself: I've been in financial services over 20 years. And in 2020, I had my Jerry Maguire freakout moment when I said, screw you and screw you and screw you. I go start my own thing. And I did. And it's been so wonderful and such a blessing ever since. And I really love working, especially with small business owners and entrepreneurs who have all these big ideas that I never had the big ideas, right? Like, oh, I'm going to go start my own, I don't know, apple candy factory. I don't know. Someone actually just told me that. So that's why I came up with it. But I love supporting you guys. So that's what we're here for today. I'm going to give you 5 questions that you can answer at the end of this presentation that really help you look at your numbers from an outsider's perspective and give you the why behind it. Okay? Sound good? All right. So I will send this to Jean Marie at the end so you can forward it out to whomever wants it. A little bit about me here. You can read it later. I now live in Anchorage, Alaska. So I'm a little bit strict. I know, right? And, all the things about me. But I want to say that this is not about me today. It's about you. Okay. So what we're going to do today, like I said, we're going to make sense of your numbers in plain English. We're going to get excited, I hope, to look at your books every month. Maybe not as geeky as I am, but and step into your CEO role with confidence, because you guys are the CEO of your business, right? You should be able to speak confidently about your numbers. All right. Okay. So we're going to start with a question. This is sharing time. All right. I want to know, why did you start your business? So I'll go first. I started my business because I wanted to really be a role model for my daughters, my nieces, my little cousins, all of these women that I saw in my life that, I hope they grow up to do all these amazing things, right? And if you don't have the numbers to support the business, I really don't think that, well, I do know that life will be hard, right? And so I want to have them educated. I want them to know that it's okay and that there's just a few things that they need to know in order to be successful. Yeah, I hear that so often. People start their businesses because they want to be in control of their own destiny, of their own schedule, of their own whatever. So, yeah, thank you for sharing. Yeah, that's another reason I hear a lot of, you have great ideas and you maybe do something differently, or you have a different product or service that is just needed and wanted out there. And that's why people start their businesses all the time. Yeah. Jean Marie?
Yeah, hi, I'm Jean Marie. So I started this business, Little Shadow. I have a coaching practice on the side, which is separate. Um, I started Little Shadow initially because much like Ronnie, I was working for everybody else, doing everybody else's stuff, and I had ideas and I wanted to be able to apply for grant money and things like that myself. And I wanted more freedom to pay the artists that I was working with, which is hard to do when you're working for somebody else. So that's how Little Shadow started, and then the mission has definitely shifted, where we're definitely still doing that, and we have a new show coming out, which I'm excited about. But mostly, what we're doing now is trying to serve the needs of our community in a unique way.
Mm,
So that's what our mission is. Like, we want to be like a turnkey. What is it you need? We have somebody who can help you there.
that's
and
great.
and that's what we're
Good
doing tonight.
vision. Yeah, yeah. I love it. I love it. You guys are awesome. You're creators, you're imaginative. I mean, this is what the world needs, right? We need more of you all here doing what you do best, and serving your customers. So now we're going to answer these 5 questions that I told you about, okay? The first one is, can you pay your bills? Second one, how profitable are you? How risky are you? Who is serving whom? I did ask an English teacher if that was correct grammar. So I'm hoping it's right. And then the last thing is, how would you score your business? And we'll get to that in a second, okay? Don't worry, like I said, about writing everything down. It is coming to you in your inbox soon. Okay, so if you have your balance sheet from QuickBooks, if you have your profit and loss statement, also known as your income statement, go ahead and pull that up just while I'm talking, because I want you to be able to calculate your own numbers. Okay, can you pay your bills, right? In the finance world, they call it liquidity. Okay, companies that have a low liquidity number, they're the ones that are prone to disaster. COVID was a really good example of that. A lot of companies had zero to little liquidity. When the lockdown came, they weren't able to supplement this liquidity. They weren't able to pay their bills. They went out of business like that. Okay, so I want you to have lots of liquidity. So we're going to calculate on your balance sheet. And it's simple math. Okay, so you're going to look for the column that says current assets, and look for the section or column, however it's organized, says current liabilities. Okay, current just means less than 12 months. Okay, so a current asset would be something that you can convert to cash within 12 months. So I'm talking about, like your checking account, your savings account, if you have any CDs, not a house, right? It's going to take a while to sell that house. None of these other, like maybe you have a big John Deere tractor, right? It might take a while to sell that. I don't know. Or if you have a theater, right? You guys are in the arts. So maybe you have a theater somewhere. It would take a long time to sell that. It's still your asset, it still belongs to you, but it's not current. Does that make sense? Okay. So in this example here, I just took 101,000 divided by 50,000, and I came up with 202. So what does that mean? Well, that means that I have $2.02 for every $1 of bills to pay. All right, makes sense? So calculate your number. But I always say, so what? Whatever that number is. Back in the day, before COVID, is it like PC now, pre-COVID? Pre-COVID, people would say 0.5 to 1 was considered healthy. Okay. And you could still think that that's healthy, right? But now we have the whole R word coming up, recession, right? So I would challenge you to think, well, maybe something more like 1.5 to 2.5 is a little bit more conservative. Okay, so whatever your number is, figure out where it falls in this range. Okay, everyone following? All right. If you have lower liquidity than maybe you would like, maybe you're sitting at 0.25 and you want it to go to 1.5. What are some ways that you think you can increase liquidity? Decrease your liabilities. Yeah, exactly. Pay off those credit cards. Yeah. Jean Marie, were you going to say something?
I was going to say, like, reduce your costs, your overhead.
Mm-hmm. Yep, you can reduce your costs. Yeah. Yeah, easy peasy, right? One thing that I tell my clients to do, I call them financial burpees. And so everyone hates me for it, but it is really good. And CEOs do this every year. They do a full on budget analysis, right? And what they do is download all last 12 months of expenses, and they go through with a fat red pen and they just start cutting, right? That is a good exercise for you guys to get into the habit of doing at least once a year, because a lot of these expenses creep up on us and we're not even aware of it. Okay. Financial burpees, go do them. You'll be cursing my name, I promise. All right. So the second question, how risky are you? How risky are you? And this is on your balance sheet still. Okay. Now, I'm not talking about owning a bungee jump business or anything like that, right? I'm talking about if you went to the bank and you applied for a loan, the banker is going to pull up this ratio as number one. Okay. They're going to see how risky is your business as compared to the loan that they're about to maybe give you. All right. So this is called your debt to equity ratio. Again, on your balance sheet, you're going to take this time the total liabilities. So we'll go back here, right? The liquidity ratio was just current liabilities. So like your credit cards or your accounts payable, okay? Anything that was due in less than a year. I'm talking now about all of your liabilities. So your mortgage, your long-term loans, lots of business owners got that SBC loan, the EIDL loan, if you've heard of that term, EIDL. Any other kind of loans that you owe, but maybe they aren't due for another 5 years, 10 years, 30 years. Okay. Add them all up. And then you're going to divide it by that equity number. So equity is a little subjective, I will admit. Okay. It's made up of the blood, sweat, and tears of your business. You can think of that as your equity. Okay. How many times did you not pay yourself? How much money did you put into the business? Those are called retained earnings. Okay. So again, simple math. And for this example, I come up with 0.739. Okay. That means I have 73 cents of debt for every $1 of equity. Okay. So if I'm the bank, I'm putting on my banker's hat, right? I'm the bank. I'm going to sell this business here that you see on your screen, right? And then I'm going to pay off all the liabilities, right? I only have 73 cents of debt for $1 of equity. So I'm not going to get a lot of return. Okay. Does that make sense? All right. Again, so what? Who cares, right? This one, I want you to think of if you are anywhere less than one, you're healthy. Okay, it's healthy. If you are over one, you are what's called over leveraged. Basically, you have too much debt for your business. All right, so find out what that number is in your business and calculate it. All right. A lot of times people come to me and say, I want to go get that loan. I want to go get a short term loan to do some expansion or to do a project or whatever it might be. And I say, all right, if we were to go and get that loan, would that push your debt to equity over one? Yes or no? Okay. So when you have that kind of a question, go back to your balance sheet and where it says total liabilities, right? Let's say I want to go get another $50,000, right? So it'd be 170 plus $50,000. And then I would divide that by 230. And that would absolutely push me over that one mark. Okay. That's how you use this information. Yeah, go ahead.
So I just want to make sure I'm understanding correctly. So if I'm at 0.79 and I go to get a loan and the loan is going to send me over one, I don't really want to get a loan. I need to make adjustments to my business.
Right.
Okay.
Yeah, that's a good way to look at it.
Okay.
And bankers will have different requirements too. So if you go to, let's say, like a credit union or a local bank, they're going to have a different ratio cap. They're going to have a different limit. All right. If you go to maybe the bigger banks like Bank of America, Wells Fargo, they typically have higher caps because they're bigger and they can absorb. Like if you stop paying on your loan, if you go out of business, right, they can absorb that better than the smaller banks typically can, right? So just because one bank might say no, you can still go to another bank and try to apply. Okay. But for your own purposes, try to keep it under one. Okay. Or if you're over one, hopefully it's temporary. It's maybe only a few months because oh yeah, I'm going to pay that off in the next quarter, whatever. Okay. All right. Good question. Okay. So ways to decrease your risk if you are over leveraged. If you have too much debt, right? Obviously, pay off your debt. Okay. Another way you can do this, and Jean Marie, we kind of touched on it before everyone hopped on the call. Go in and look at who owes you money and go collect it. So Apple, Apple, the software company, the computer company, they have an average accounts receivable, right? The people that owe them money is about 2 weeks. So if you want to do business with Apple, you are going to pay them within 2 weeks. In what I do when I talk to other business owners, it is very common that I see bills where people owe the business owner money over 275 days old. And I ask them about it and they're like, well, and then there's some kind of sob story. I don't really care. Assign someone and go get that money because that's your money. Okay. Obviously, managing your cash flow is just super important when it comes to the risk in your business. Okay. And then getting higher profit margins, which we'll talk about next. All right. Okay. This is my favorite question because I don't care if you make $10 million in revenue or 10,000 in revenue. There are lots of business owners that I know that have millions of dollars coming in and they are not profitable at all. Okay. So I want to know, how profitable are you? And for this, you need your income statement, otherwise known as your profit and loss or P&L. There's an acronym, which I said I wasn't going to use, but profit and loss statement. Okay. This is the most important piece of information in your business finances. Okay. Always want to be profitable. All right. So this is a little bit harder math. Stay with me. You remember the order of operations, right? We're going to do what's in the parentheses first. Okay. We're going to measure first the gross profit margin. So you're going to go and take your revenue, right? If you made this one 500,000 in revenue, I'm going to subtract what's called COGS, cost of goods sold. So let's say I am a national supplier of t-shirts. Okay. I made these t-shirts. I sold them for $500,000 last year. It cost me $200,000 to buy those t-shirts. Okay. In this example, I got 500 minus 200. Now I'm going to divide it again by the revenue and then come up with a percentage. All right. 60% is pretty good, right? So if you make or sell something, you want to pay attention to your gross profit margin. Okay. Now, you guys here are in the service industry though, right? So I don't care about your gross profit margin. I want to know what your net profit margin is. So in addition to the cost of goods sold, I want to know this OpEx number, operating expenses. How much did you pay for your software, Zoom subscription, your rent, your pencils, your everything else, right? Headphones, I mean, whatever it is that it takes to operate your business. I want to know what that operating amount is. So you saw in this example, the gross profit margin was 60%, right? Pat on the back, woo woo, look at me, right? But if I'm looking at the net profit margin, all of a sudden now I'm down to 5%. Okay? Very big difference. So if you are a service-based company, this is the number I want you to pay attention to. Okay? So what? Who cares? Well, let me tell you, this is going to be different for everybody. And I'm sorry, I don't know what it is for the puppet industry. Okay. But that's where you guys get to do some research. I would say, as a rule of thumb, if you are between 0 and 10% net profit margin, you're kind of in trouble, right? There are some things that we need to figure out. If you are over 10%, then you're considered healthy. Okay. But there's a lot of caveats to this. First of all, you have to compare yourself to other companies that do what you do and figure out, okay, is it supposed to be 10%? Maybe it's supposed to be 50%. I don't know. All right. You have to do some research there. Number two, you get to decide, right? You might all have different profit margin goals, even though you do the same thing. But you guys get to decide what that is because you are the entrepreneur. You are the one that is tracking this. Okay. And the third thing I want you to think about is it doesn't matter what it is today. I want you to compare this over time. What was it last year? Okay. You can pull up your profit and loss statement from last year. Look at it, what it is today. Figure out what you want it to be this time next year. Okay. And you're going to look at the trends. Okay. Questions? I've got so many soapbox I'm about to stand on.
Don't
Okay,
slip.
don't slip. So first of all, I would challenge that because the IRS will say if you don't make money after many, many years in your business, they consider that a hobby. And what they would do if you got audited, okay, they would go back and look at all these other years and they're like, look, you're getting all these business taxes and business credits for a hobby. So now we're going to recalculate to what we think you should owe us and then, slap on the wrist. Okay. So that's a kind of that's a very slippery slope, I think, to go down. You did bring up a good point though, because sometimes in our business, especially during startups, there's the startup phase and then even the growth phase. Okay. You can experience losses, and those losses do count against your income, and they do even carry forward depending on how big the loss was. So you're absolutely right. It's not always a bad thing. However, if you go into business for yourself, true business, you should be expecting to make a 50% return on investment or more. Entrepreneurs know that they can do things that we can't do in the stock market. In the stock market, historically, not counting this year and last month, but historically, we can get maybe 7% year over year, 8% return investing in the stock market. Business owners are notorious for this, and they say, well, screw that. I can do 50% by opening up my own business and doing all of these things. Okay. So when I say you decide what your profit margin should be to make it worth your time and effort. Okay. And then going back to that question of, okay, but I put in all this time. Does that count in terms of my profitability? You should be paying yourself. Okay. And that is actually the last question that we're going to answer. When you opened up your business, remember that question that I asked you at the beginning? You opened up the business because you had great ideas. You wanted the freedom and the flexibility, and you wanted to do things your own way. You did not open up your business in order to become a slave to your business, right? You knew that there were going to be some hard times, blood, sweat, and tears, and all those things, right? But your business should be the thing that's serving you. So if you are not paying yourself, we need to fix that. Okay. You should be paying yourself first. Okay. And brings me to my other soapbox here, and then I'll get off, I promise. But, America was built on the backbones of small business, right? Most of America is employed by small business owners, but they're not actually employed by the Amazons and the Apples, right? Maybe Ford back in the day, but most of it's small business owners. When a small business owner goes to retire, statistically in America, 9 out of 10 of them will have a garage sale and then close the doors. Okay? That's not okay in my book. You worked really hard at your puppet business. You should have some value built up in that business, and you should be able to sell that or whomever. Okay? You should have that business as a separate entity that says, look, I've done all these things, and now next generation, you should come in and you should buy it from me because I've laid the groundwork for you. Right? And then we can all go to Cabo and sit our butts on the beach and drink margaritas all day long. Right? That's what I want for your business. That's what I want for your dream. I want that business and your legacy to continue on after you have decided to go do something else. Okay? Yes.
Can I just offer an example though, in that like a puppet centric example there? So,
yeah.
So there are those people who have like performing repertory companies where they don't want the puppets anymore. They don't want the overhead of the business. Like they sell the whole company. People go do their shows, right? They can retire. They've sold the company. You're an individual, unique artist, right? And so the prospect of selling your company looks so different than it would to sell Paul Mesner puppets, right? It's like such a different thing. However, you're still building a Rolodex. Like there's still, I just want to offer to you or somebody watching later who's like, no, when I retire, I'm keeping my puppets and they're going in a museum. Like that's what's happening with my stuff. If right, like that's great too. But there's not equity coming in from that, right? There is a slight deduction when you donate that, but usually it's like the people who after you pass on, they benefit from that. So for someone like yourself or any independent artist who's watching this, like you still have a business that is outside you stepping on stage with a puppet.
Mm-hmm.
So tracking that is the thing that you can still sell.
Mm-hmm.
Knowing your Rolodex, knowing how much money is in your company, like there is still something to be sold there. So I'm just saying that because I know how many people, Christina, would be like, oh no, I'm an artist and I'm dying with my paintings. And most artists truly, they make more money off their prints because they want to keep the originals.
Mm-hmm.
Right. So like there's a conversation to be had there. And I just want to raise that flag of like, yes, what she's saying is still possible for everyone.
Yes, good point. Thank you, Jean Marie. Yes, because there is value in those contracts. Okay, so you were talking about going to schools, right? If, let's say, you had a 5-year contract with the public schools to go in and do whatever shows, once a month or whatever it might be, you can sell that contract to the new owner. Sometimes people actually buy companies for the labor. Last year, people were buying smaller construction companies because they couldn't find the laborers, but they could find this little construction company that had laborers but didn't have the contracts to go do the work, right? Sometimes they're buying, like Jean Marie said, your Rolodex. Who do you know? Right? Your name, your brand reputation, all of these things build the value of your company. And so people will pay dollars for that, actual cold hard cash. Something to think about, right? I'm hopefully just giving you this information to tap into the right side of your brains. Okay. That's it. So, yeah, I mean, you're absolutely right. You can have this red line business and still be a legit business. Okay. You guys are not doing what you do because of the dollars. I know that, right? You're doing it because of the passion and the love and the artistry and all of these things. Okay. So I challenge you to put on, though, that side of your brain and start thinking in terms of all of these Wall Street financial people. Okay. And what that's going to do is hopefully help you have an easier time if you need to go to the bank and get a loan, if you need to expand, if you want to hire, right? That's what I'm hoping that this does. So it's just food for thought. But yeah, good point. Good point. Okay. All right. I'm going to show you an example here. This is an example of a profit and loss statement. All right. I had this client last year, and you can see here September 21, October, November, December, right? We've got all of her income and then all of the expenses, operating expenses. Ignore this yellow line. She didn't have any health insurance, so it was kind of like a reminder to us, like, we need some health insurance. And then she had a contractor, and then her wages and her net profit margin down here, 0.91%. Okay. What she was doing was essentially like whatever was in the account at the end of the month, that's what went into her pocket. Okay. I said, this is not quite great news. So how can we fix that? Because her question was, do I need to raise my rates around this time? Everyone says, oh, I want to charge more, right? Do I need to charge more? Do I just need more clients? I want to hire someone. Can I hire someone? All of these things. Okay. So I said, all right, we're going to set a small goal that next year you're going to have a 6% profit margin. Okay, 6%. So then we back into it. So then we said, okay, here's my 6% goal. You see that there? What does that mean? How much revenue do I need to bring in? Well, assuming that you got to figure out what it takes to feed and clothe your family, right? And you're going to pick a number, whatever that number is, that's going to be your number every month. None of this, like sometimes 34,000, sometimes 19, like that. Your family needs to rely on a steady income, okay? So she picked a number because she was the breadwinner. She had a lot of kids. They lived in an expensive city. 16,000 a month is what she said she needed to live. And she wanted to hire somebody else. Okay, what does that look like? See this 9,000 here. All right, still no health insurance. But then we said, all right, she needs to bring in revenue of 49,000 a month. Okay. Well, shoot, man, she already could knock that out of the water with her eyes closed. Okay. So she said, well, I don't really need to increase my rates then. What I needed to do, and what she decided to do, was actually whittle down her client list and the projects that she was working on. And she said, look, I have too many things going on. I'm doing a little bit of this and a little bit of that, and I can't focus my time, right? So I'm going to get rid of this and I'm just going to focus on this. Okay. So if I did that, and let's say she wanted to overachieve here. So she wanted a 15% profit margin goal. So, okay, fine. This is what it looks like. If she went for 15% and everything else being the same, she would have to bring in 54,000 a month. Okay, you following? So that's how we use your profit and loss statement. That's how we kind of back into all of these questions that you might have, like, should I do this? Should I do that? What does it look like if I do this or that? Right? That's why it's important to look at your profit and loss statement every single month. Does that make sense? Okay. I'll send this to you too, so you have this copy. I also have a template. I'll send you the Excel spreadsheet so you can kind of go in and do that too. All right. All right. So how can you fix it if you are not profitable? Remember, I know we're still talking about this, but I love it so much. Okay. I want you to think about all the things that you do in your business, right? And if you want to increase profit, here's just some ideas. And I want you to start with the price that the customer is willing to pay you. Too often, business owners say, remember my t-shirt company? I bought a t-shirt for $10. I'm going to upcharge. I'm going to sell it for 15. Okay, too many times we do that. So here I have a pencil. This is my pencil company. And I bought it for 10 cents and I'm going to sell it for 15 cents. Okay, seems reasonable, right? And I've got a marker and I bought this marker for, I don't know, $1. I'm going to sell it for $1.25. Okay, seems reasonable, right? Lots of people do this. But what if I went to you and I said, hey guys, what would you pay for each one of these items? All right. And Jean Marie's like, pencil? Like nobody uses pencils anymore, Christina. What are you talking about? I would pay 5 cents for that. Right? So if she said that to me, all of a sudden I've got this new information that OMG, I'm charging 15 cents and she would only pay 5 cents for this. Okay. Or if I said, hey, Ronnie, how much would you pay for this marker? And you're like, oh, it writes upside down. It's so smooth and the color is vibrant. I'd pay $2 for that. Right? I'm like, ah, so now I'm undercharging. Right? So ask your current clients, ask your prospects, ask your friends, get a good sampling, ask everybody, what would you pay for my service? Okay, you'd be surprised what they come back with. Okay, and then I want you to focus on the profitable thing. I am no longer going to be called Christina's Pencil Company. Pencils are dead, apparently. I am only going to focus on markers. Markers are the way of the future. Okay. And what that allows me to do now is take my service or product and really scale and grow. And I'm going to put all of my energy into this one thing. I love pencils. Look, it's pink. I love it. It's so great. I'm going to be very sad, but who cares? I'm only here to make money. So pens it is. Okay. All right. Next thing, cut your expenses. I told you about the financial burpees. Go and do that. It's very Zen, it's very Buddhist of us to go and look at our expenses and be aware of where we're spending our money. Okay. Leverage technology where you can. It's not there for everybody, but who has secretaries anymore? I don't. I have Zoom and I put in a little voice message when I can't answer the phone, right? And this last one, I think is just so important. And it is your leg up on the competition is that customer service. When you call a big company like AT&T, okay, I have my mobile service with them. I call them and I get transferred 50 times and nobody really cares about my problem, right? Versus the small business owner, you can own this. It may not be your fault that I no longer have cell reception, right? The satellite was knocked out of orbit in space. That's not your fault, but you can own that experience for me and you can really go in and see to it that I'm happy at the end, that I get my problem resolved, that all of these things. And what that's going to do, like, what the heck does that mean? And how does it relate to profit? You're going to get customer referrals. Your brand reputation is going to go through the roof, and people are going to come back to you over and over again. Okay, that's how you build profit into your company. So, this last one, who is serving whom? It may or may not be on your balance sheet. Small business owner, I know you don't reconcile every month, you don't do all the things, that's fine, right? But I really want to know, sorry, did you start this business to be the slave to your company? Probably not, right? So are you paying yourself? Do you at least get some kind of equity at the end of all of this? What is your return on investment? All of these things should be coming back to you. So when you build your company, you got to think about the numbers because I want this company to serve you and serve your lifestyle so that you are not on the hamster wheel. So you're not doing all the things that you don't want to do, right? Very important. Okay. And don't tell me, please, dear God, do not tell me that you're reinvesting back into the company and that's why you're not paying yourself, because I'm just going to come. Okay. I think it's an excuse that a lot of business owners use as to why they're not paying themselves. Okay. There are other things that we can do in your company to get you to this point where you're getting a regular paycheck. All right. And this last question here is, how would you score the financial health of your business on a scale of 1 to 10? Okay. Write the number down. You don't have to tell me what it is. But here's the thing. You guys are the business owners. You're the CEO, and you have that gut instinct. And that gut instinct has served you so well over the years, right? You know what the financial health of your business is like. I've just given you the tools to strictly point to why you feel that way. So if you feel a 5, now you know why you feel a 5. If you feel a 6, now you know why you feel a 6. Okay? So if this number is not where you want it to be, or even if it is, I want you to set a goal right now, right on your paper. What do you want that number to be next year? Okay. All right. So last slide here. I love high heels. I don't wear them anymore because COVID and but E. Faber, the Faber family was a pencil company on the East Coast there. And he said, finance without strategy is just numbers. And strategy without finance is just dreaming. Okay. I know you guys love to dream. You have big dreams, and I want you to achieve them. I want you to achieve them fast because life is short. So now you know how to apply those numbers, I hope, to your business so that we can actually move your company forward and you can ride off into the sunset with me and go sit on a beach somewhere. Yes, that's so true. I know even, when I started my company, there was no amount of money that could replace that freedom and that joy. And I get it. And you're absolutely right. Yeah. You can't pay me millions of dollars to go back to that place where I was. Right? I am happy. Yes. So this is strictly just about the financial stuff. It has nothing to do, right? You're the owner, you're juggling all the things. You're juggling the finances. You're juggling your employees or your customers and their happiness and success too, right? So it's just as a business owner, these are all the things that we keep hopefully juggling in the air and don't let fall.
To me, the hope of this, of bringing Christina into our world, was to help people who are dedicated to their creativity and aren't going to put that down, nor should they, right? It's a vocation. But when the panic sets in, we can reduce that a little bit so that there can be more creativity.
Yeah. Things in black and white stand up really well, right? So what do your responsibilities look like? Can they write that down for you? What does your job description look like? What are these contingencies? Okay. And even if, let's say, they write down your job description and you get in there and you're doing things that weren't in your job description, that's an opportunity maybe for a reassessment. You say, hey, this was the original scope of work. This is what you hired me to do. It turns out I'm doing this, right? Can we negotiate? Like, I really like doing some of these things, but not all of them. Can you pay me more? Right? Whatever it might be, but it's an opportunity to have that dialogue. Thank you so much, Jean Marie, for having me here. It was so wonderful to talk to you guys tonight. And I hope that this just gave you some food for thought, right? Just something to marinate on. Take what you can and what you want and apply it to your business. It doesn't have to be everything, but hopefully I've given you some tools that now you can use in your business.
Thank
All
you,
right.
Christina. This was awesome. I hope it radiates
Yes.
throughout our community. Thank you.
Yes, yes. And if you want a copy, I'll send it to Jean Marie, but if for whatever reason it doesn't come through, you can always email me and I will email you back directly. Okay?
Awesome.